Hello, I'm Ben Jones and welcome back to Dukascopy TV. Later on today, the FOMC minutes from the meeting in March will be released. After last month's meeting, Yellen arguably took a hawkish stance in some of her comments and outlined the potential for an interest rate hike next year. Joining me on the line to discuss what we might hear from the minutes and the current state of the US economy is Charles Dumas from Lombard Street Research. Now, Charles, with the minutes being released this evening, what market reaction have we seen since Yellen spoke? Did it give people a more positive stance on the US?
Well, I think the US economy is expanding now and is likely to continue to expand well. We had a bit of a flurry of pessimism over the winter because of the bad weather, but also because at the end of last year, America built up a big overhang of inventories, which obviously held back production early in the year and caused the manufacturing side to go down in January. So that was a problem then, but the underlying tone is extremely strong, with growth in the region of 3%, taking one quarter with another. And that means eventually, well, it means first of all that we don't need so much monetary ease as is implied by quantitative easing. And when that's being withdrawn, which we expect to have happened by the end of the year, then the question of establishing more normal interest rates will arise. And so it has to be reckoned that sometime in 2015 they will be raising rates. And I don't think the market is I don't think the market's view about the Fed's behavior has changed on that over the last couple of weeks.
So you feel that the US economy will be ready for an interest hike as early as 2015. What factors do you think are key in determining this?
Well, I say, when you say as early as 2015, I'm sort of saying during 2015, so that gives you a range of 12 months, although I think Mrs. Yellen in her comments sort of suggested that it might be around the middle of next year. And the main point here is that if you have a reasonable expansion, you would expect interest rates no longer to need to be at highly concessionary levels and extremely stimulative levels. It's only fair to say, though, that the rest of the world is very much less buoyant than the United States. Europe is maybe growing at about 1%, Euroland that is, which starting from the very depressed level they were at a few quarters ago means that they're staying depressed because 1% is simply on trend. It doesn't get them back to anywhere near full employment. The deficit emerging markets have taken strong restrictive measures. China is in trouble because of sort of rapidly mounting debt and serious currency overvaluation. And Japan is exporting deflation by trying to sort of get its yen down. So one way and another, the whole of the world is basically pushing money out of itself. The Europeans have a very large current account surplus. The emerging market deficits are being reduced. China is slowing down, as I said. And Japan is also trying to get itself back in surplus. So one way and another, money has to go somewhere, the excess savings in the world, and the most natural destination is the United States. So that could tend to hold interest rates down for longer than people expect. But this may well express itself more in the bond market than in the money market. The Fed may decide that, at least in a token sense, it wants to indicate a return to normality by having interest rates at more normal levels.
And finally, you've stated that you believe in a strong US recovery despite some deterring data over the winter. What do you feel is driving a recovery at the moment?
Well, there are sort of negative and positive factors. The negative factors, which are very important, are that the main things that were wrong with the US economy have been corrected. There's no longer excessive household debt or debt service requirements. Debt service in US households is now the lowest it's been since the records were kept from about 1980 onwards. There is no longer, the government deficit is now being reduced to almost sustainable levels of, on a structural basis, it's at just about 4% of GDP. So it's coming down towards something which can be sustained, and it's being reduced all the time further. And the other big thing is that the dollar is very competitive, and so the US is competitive on world markets. What this means to us is that there will be substantial expansion of business capital spending because it's no longer a great deal for people to export jobs, so to speak, to China. It makes more sense to create business in the United States and invest there.
Charles, thank you very much for joining me today. The minutes are released at 7 p.m. GMT this evening. That's all from me for now, but stay tuned to Dukascopy TV for even more updates and exclusive interviews. Thanks for watching. Goodbye.